Hi everyone. So I just thought I'd work a problem for you guys. I just because I think it might be helpful to see the logic on how you think through some of Connect homeworks. So we're given question 7 on chapter 3 homework, and we're given Stacy's piano rebuilding company has been operating for 1 year. And the way to solve this problem is to first give yourself an idea or a sense of where we are in Stacy's piano rebuilding company's life cycle to understand what is being asked of us. So if you remember from class, or maybe I told you, at the end of every year, you take an income statement, and what you do is you close that out by moving any net income that you have made into your retained earnings so that you have gotten rid of those temporary accounts, which are revenue and expenses, and you have added everything back into your balance sheet. So balance sheet is permanent. Balance sheet stays with you all the time. Income statements, where they are made, are just contributing to your retained earnings in your balance sheet. And so the question asks, at the start of the second year, its income statement accounts had 0 balances, and its balance sheet account balances were as follows. And you're given a balance sheet. And this paints the picture, when you understand the problem right, that the first year, they've closed out their income statement. They've moved their net income from their income statement to their retained earnings already, so that at the start of the second year, they don't have an income statement yet. Now, what we're given is several things that happened in January, and they're asking us to prepare an income statement for January 31st, especially since the clues in the problem tells us that they don't have one. We need to be creating it for them. Another clue in the problem is it tells you exactly what's expected. You're looking for an income statement that's unadjusted. And so you're not going to be given any of those 4 vocabulary words that are in the textbook: accrued revenue, accrued expenses, deferred revenue, deferred expenses. That's not going to be in this problem. Those 4 words in the textbook from chapter 4 are only for adjusted income statements and adjusted balance sheets. When you're computing an unadjusted, you don't have to worry about those 4 words. All right, so what we're getting at is that we got to reflect what happened in January in our revenue and in our expenses in an official income statement. That is also giving us a clue that we do not have to worry about this balance sheet right here, really at all. Because all they're asking is an income statement. They're not even asking us to move our net income from the income statement to the balance sheet. They're just asking for the income statement by itself. So like this balance sheet that they gave you can almost put it out of your mind. You don't need it. All right, so to do this income statement, first we got to give it a title. It's Stacy's Piano Rebuilding Company. Then we tell what it is, and then we got to give it a time. And with income statements, because it's reporting what was made over a period of time, you want to do for the month ended January 31st. Income statements are not a balance sheet. They're not a snapshot of a particular moment in time. They are for a period. All right, now we got to figure out operating revenues, operating expenses, total operating expenses, and all this other stuff. Remember, and this is going to be critical in this problem, there's a term in the vocab in the book called revenue recognition principle and expense matching principle. Revenue recognition principle when simplified to easy definition to understand, is that you do not put revenue on the income statement unless something was a product was actually delivered to a customer. So think about wine selling. If you buy a bottle of wine and the clerk hasn't given you that bottle yet, it's not revenue. Once the clerk hands you that bottle and delivers a good for the operating revenue to you, or I like to say it this way, has done the work, then it's considered revenue. With expense matching principle, you can ignore most of what the textbook says about it. The truth is, what you want to ask yourself is, was the item, asset, liability, or whatever actually used? Because expenses only get counted on the income statement when they were actually used by the company, by the organization. The expenses matching principle in the textbook is really just trying to say, if you make revenues in a particular period of time, you have to add in the expenses that were incurred when actually making those revenues. But to really just simplify it, ask yourself, was the thing used by anybody in that organization? So let's work through this. A, we built and delivered 5 pianos in January to customers who paid $18,700 in cash. These pianos were delivered. A good was delivered to the customer. And so I would put this in revenues. Revenues. Rebuilding fees, revenues. And I would put $18,700. The next one. Received a $590 deposit from a customer who wanted her piano rebuilt. Here's the thing. Just because you receive a deposit doesn't mean any work was done or that the piano was delivered. So you don't think about it. It's not something you put in this income statement at all. No work was done. The product was not delivered. Therefore, no revenue gets recognized. Rented a part of the building to a bicycle repair shop. Received $900 for the rent in January. This is rent in January for the bicycle repair shop actually doing what it's supposed to do. So I would put this as actual recognized rent. Rent, revenue. And I would put this in other items because this is not the main thing that your business does. This is recognized rent from a bike repair shop and their work that bike repair shop did during that period of time. This is not, your shop is a piano rebuilding company, so this is not your operating. This is not what you do. This is what the bike people do. Therefore, it gets put into other. D, received $8,200 from customers as payments on their accounts. Because you received payment, you don't know if work was done at all. You just know that they paid you. You have to, in each one of these, know that either a product was delivered or work was actually done in order to put it as revenue. Now, this can be really confusing because you can almost just sort of stick it into revenue because it's $8,200, you got payment. But you actually have to know that work was actually done in order to actually stick it in your revenue. Received an electric and gas utility bill for $510 to be paid on February. This you put in expenses under utilities expense, and you put for $510 to be paid in February. Because you used it in January, so you have to mark it down even though you're paying it later. You used it in January, it goes on January. Ordered $950 in supplies. Just because you pay an order doesn't mean you actually have used these supplies. So you don't worry about this right now. If you use the supplies, if you're given a clue that says these supplies have been done before, then you put it down, but only if you have used them. Paid $13.40 on account in January. That's the same idea. Just because you paid for it doesn't mean you've actually done any work or used anything or incurred any expenses. The act of paying doesn't mean you actually have an expense that you record. Received from the home of Stacy Eddy, the major shareholder, a $960 tool equipment to use in the business in exchange for 150 shares of one par value stock. This one you might put in the balance sheet, but again, you haven't used this tool. You just received it, and it's just an exchange of payment and tool between the stock and the major shareholder. Now, if you had used this tool, you could mark it as an expense, but you're given no clue that it was used. If you had been sold this tool as part of a sales transaction, and this is the delivery of the tool, then you can mark it as revenue. But this is just an exchange. This is addition and balances and accounts. You're not actually talking about a sale, a delivery of product, or work that was done. Paid $14,900 in wages to employees who worked in January. So I'm going to put that right there as a wage expense, and I'm going to put that as $14,900. People worked in January, you record it. People were used, your workers were used, you record it. Declared and paid a $1,800 dividend. Reduced retained earnings and cash. This might go in the balance sheet, but because nothing was used, nothing was earned, nothing was delivered in terms of a product, in terms of a sales transaction, when you're going to the store and you're actually being sold something, you don't put this at all on this sheet. Received and paid for the supplies in F. Again, these supplies have not been used, so you don't put this at all on this sheet. Now we're left with a couple things we have to put down. We have to total up the difference between our expenses and our revenues. And I'm going to put that right there, I believe. And I'm going to call that operating income. That's for just the work that Stacy Piano Company has done. And I'm going to look at this, and we have 18,700 minus 15,410. 18,700 minus 15,410. And that's going to be 3,290. 3,290. And then we got to put one more thing here to talk about our net income. And I'm going to put that right there. Now note, it does say ignore income taxes. If we weren't ignoring them, this would be another line in this, and we'd have to care about it. But because we're ignoring them and we're not doing adjustments, you should be done at this moment. Let's go check our work. Answer is complete and correct. We are awesome. Thank you very much, and I hope this helps.